fundsupermart.com.
Hi, what is the macro environment like for 2014 and what is the impact on the Asia fixed income market?
Well, we could talk about the recovering US economy and in the Eurozone, the periphery performing better, an increase in activity in Japan. But I think the most important global theme is actually the subdued nature of inflation and falling inflation in many sectors and parts of the world. What that means for Asian fixed income markets is two things. One is that because interest rates may remain lower than people expected, the core yields will remain low, but it also provides a good environment for many companies, and in that sense I think that it's positive for credit markets as well, and that should mean a continued low default rate in Asia, but also the scope for steady core bond yields there as well.
Within the Asia fixed income market, how attractive is it relative to other fixed income segments such as high yield and emerging market debt?
Well, the high yield complex is very clear indeed, because you get a very significant pickup in Asia compared to the Europe or the US high yield markets. If you look at a chart, you'll see that spreads tightened very significantly in 2013 in the US and European markets, but remain very wide in Asia. And I think this is partly to do with some nervousness about the outlook for the Chinese economic outlook, and China is an important part of the Asian high yield market. However, the beauty of fixed income, of course, is that if markets remain cheap, well, that's fine, because you continue to pick up the extra carry. That's provided, of course, you don't get defaults, but we expect defaults rates to remain very low. In the emerging markets complex, it's quite difficult to fit Asia into that sometimes. Asia is a higher quality, lower yielding than emerging markets as a whole, but of course contains some emerging markets itself. So from that point of view, we think that if you want a lower volatility, higher quality investment, then Asia is a better option than a broader emerging market strategy.
Bond investors fear rising interest rates. Is there anything positive from rising rate climates?
Well, I think that the obvious thing to say here is that in a low inflation environment, if interest rates are going to rise, that implies a very positive economic outcome, because this will mean that central banks will feel that the economies for which they're responsible can sustain higher interest rates. So that should mean that the economy is functioning very well. In that context, it means that companies are unlikely to default on their debt payments, that defaults will remain low, and that gives some scope for spread narrowing in corporate markets. That, of course, as we've just discussed, could be very good news for Asian high yield, for instance, where spreads are around 500 basis points over treasuries. So even if US treasuries rise, the yield rises in anticipation of higher interest rates, and the spread could narrow even more significantly and provide very good performance from those types of markets. And it all depends on the speed of the tightening as well, the speed of the interest rate rises, because if they rise very gently, then some of this is already built into bond yields. So from that point of view, a clever manager should be able to manage their yield curve position to the best advantage of their investors. So broadly speaking, rising interest rates are bad for fixed income investments, but not necessarily should it mean significant losses, and you could actually get some markets performing quite well in that environment. And of course, just one final point, with if you get higher bond yields, then it will give a very good buying opportunity as well.
Any investment trends to share within the fixed income market?
Well, apart from the very positive outlook that we've discussed for Asian high yield, and probably more broadly in Asian credit, I think that some of the individual local markets are worthy of note. I think that our favourite at the moment is India. Now, everybody knows now that there's been a very positive election result for financial markets. And we don't expect the rupee to accelerate its appreciation at this point, because the central bank is deliberately leaning against that appreciation by buying dollars and replenishing India's foreign exchange reserves, which were diminished so badly last year in the unsuccessful defense of the currency. So they're rebuilding their dollar reserves, and that should keep a lid on the currency appreciation. But we do think that there's still strength in the currency, so we don't expect depreciation. At the same time, you get a nice 9% bond yield in an environment where it does look that the medium-term outlook for inflation is good. So, as I say, it doesn't really matter if those 9% yields stay where they are. You will still make your 9% carry. But there is some room for lower bond yields over the medium term. So I think that those niche opportunities, which may well be those that, as we've discussed later, just before, which are less interest rate sensitive, may be the best place for returns in the Asian fixed income markets.
Thank you.